Hello everyone, welcome back to the channel. So recently I had a call with one of my followers who had some questions about investing. And for context, this is someone who is currently in university and is working a part-time job alongside their studies. They're making just above minimum wage from that job, but they're also still living at home with their parents. So they're starting to slowly accumulate money in the bank. And essentially the purpose of the conversation was to answer A, whether or not it's possible to invest when you're on minimum wage, and if it is possible, B, whether or not it's worthwhile. So I thought that conversation would be a good premise for a video, and that's exactly what we're going to discuss today. So to answer the first question, whether or not it's possible to invest on minimum wage, the answer is yes, it is possible. In fact, the idea of investing on minimum wage has been revolutionized in the past 5 years. Up until recently, it was very difficult for people on minimum wage to invest because company share prices on the stock market can be in the tens, hundreds, or even thousands of dollars. That meant in order to buy one share in a company that was priced at, say, $250, you would have to have at least $250 or the equivalent amount of euros or pounds to invest in that company. For someone earning minimum wage, that makes it very difficult, if not impossible, to invest in the companies that they want to invest in. That all changed with the introduction of fractional share investing. A fractional share is when you own less than one whole share in a company. So instead of needing to have enough money to buy one whole share, you can now invest any amount of money in any company and receive the corresponding amount of fractional shares. If one share in a company is priced at €100 and you invest €10 in that company, you will own 1/10 of one share. That's fractional investing. The reason why this was such a game changer was because all of a sudden you could have as little as €1 and still invest in whatever company you wanted to. If you invested €10 in Microsoft and Microsoft stock increased by 20%, your €10 investment would also increase by 20%. If Microsoft paid a dividend to shareholders and you owned half of one share, you'd receive half the dividend. So you were able to participate in the financial markets without needing to have the exact amount of money required to buy one whole share in any given company. Fractional share investing was very quickly popularized during 2020 and 2021 when more people than ever before with varying levels of income wanted to get in on the action in the stock market. Fractional shares made this possible. Today, many brokerage platforms facilitate the buying and selling of fractional shares. Two examples of such brokers would be Book0 and Trade Republic, both of whom are within my affiliate network. So if you wanted to try out fractional share investing after this video, once you have all the information, you can try out these platforms for free using the links in the description. This also supports me as a creator. But before you make any decisions, let's discuss the downsides of fractional share investing and whether or not investing on minimum wage is even worthwhile in the first place. So the first thing to note is that there are downsides associated with fractional share investing as opposed to investing in whole shares. And the first downside is the selection of stocks available. Depending on what brokerage platform you're using and depending on what shares you're looking to invest in, it's not going to be possible to buy fractional shares in literally every single company. If you're looking to buy shares in a really high profile company like Meta, Microsoft, or Tesla, it's very likely that fractional share investing will be available. But it's just important to be aware that your options are going to be somewhat limited compared to what's available when buying whole shares. The second and more important downside is liquidity. Liquidity refers to how liquid something is, and in the world of finance, when something is described as being liquid, that means it can be converted back into spendable money with ease. For example, say you buy one share in Meta. Meta is a stock that is traded by millions of people every single day. So on an average day, you should have no problem finding a buyer for your Meta stock in the event that you need to sell it. In other words, you can convert your Meta stock back into spendable money with ease. How easy it is to do that without compromising on the price that you're selling the stock for is described by liquidity. Fractional shares are more likely to be less liquid than whole shares. This is something that has been called out by the Securities and Exchange Commission in the US. They noted that some brokerage firms don't guarantee the liquidity of fractional shares in a given company, even if whole shares in the same company are liquid. Fractional share investing just isn't as smooth of a process as whole share investing, and as a result, there's an extra risk that in the event of you needing to sell your fractional shares ASAP, you might not be able to do so, or at least to do so at the fair market price for those fractional shares. Other downsides of fractional share investing are as follows. Fractional shares generally can't be transferred between brokerage platforms, meaning if you decide to transfer your whole share investments from one broker to another, you may have to sell your fractional shares, or just leave them on your old brokerage platform. There may be additional fees associated with buying fractional shares as opposed to whole shares, depending on what broker you're using. And finally, because of how some brokers process buy and sell orders for fractional shares, there might be a delay between your order and its fulfillment. That can impact the price you ultimately end up paying or receiving for the fractional shares, which goes back to our point around liquidity. So those are the downsides of fractional shares as an investment option, and any decision to invest in fractional shares must be made with those potential downsides in mind. Now what I want to talk about is the reality of investing on minimum wage and whether or not it's worthwhile doing. Look, I'll be honest with you, you're not going to invest your way out of a minimum wage job. You're not going to suddenly have loads of money in your investment account just because you're investing a couple of euros each week. It just doesn't work that way. For example, if you invested 10 euro every week for 40 years, you'd only have just under 125,000 euro before taxes and inflation are even considered. The only way that you're ever going to make decent money from investing small amounts over a short period of time is by taking on excessive risk. And that's not what I advocate on this channel, because even if you do take the risk, it's very, very, very unlikely that you will come out with more money on the other side. So it doesn't matter if you're investing 1 euro or 1,000 euro. The investments themselves should always be sensible. And the most sensible form of investing for 99.9% of the population statistically is investing in low-cost index fund ETFs for 30 to 40 years. Worthwhile mentioning that both Book Zero and Trade Republic allow you to buy fractional shares in ETFs, so you can begin to execute a sensible investment strategy involving fractional shares using either of those platforms. Again, link in the description. But the reason why I'm highlighting the need to be of the mindset that you're going to be investing for 30 to 40 years and not 30 to 40 days is because I don't want anyone who's on minimum wage thinking for a second that investing is their ticket out of there. It's not. Investing is a tool that we use to grow our money slowly over time, so that when enough time has passed and enough money has been invested, we may become financially independent. But equally, that doesn't mean that starting your investing journey on minimum wage is a complete waste of time either. It's fair to say that most people on minimum wage are young adults who have just entered the workforce. And if those young adults are interested in getting started with investing, even though they're not earning a lot of money, I would encourage them to do so. Because by starting early, what you're doing is building the mindset necessary to become a successful investor. You're also getting used to your money increasing and decreasing in value. You're getting used to the process of investing money, and you're becoming familiar with the terminologies. The main ingredients for successful investing are time, money, and returns. So by starting as early as possible, you're getting the best of that time ingredient. But that's only part of the journey. You'll also need to significantly increase how much you're investing over time. And the only way you're going to do that is by earning more money. So anyone who tells you that you can get rich investing on minimum wage is either an idiot or they're trying to sell you something. Not much difference between the two. Bottom line, you're going to have to start investing at some point. So if you can, you might as well start now, but only do so with zero expectations of becoming an overnight success. It's not going to happen. I want to conclude this video with two caveats to the argument for minimum wage investing, as well as an alternative to fractional share investing. Caveat number one, it only makes sense to invest on minimum wage if you are comfortable that you have enough money in the bank to cover yourself in the event of an emergency. As we talked about recently on the channel, it's very likely that many economies worldwide will find themselves in a deep recession in 2023. What that will look like, we don't know, but it's typically the minimum wage jobs that tend to be at the greatest risk when times are tough. So there's no point investing now if you're only going to end up selling those investments to access money in the event of your unemployment. Don't let that happen. Have enough money in the bank before ever starting. Caveat number two, 2, there's not much point investing extremely small sums of money. Most brokers are going to charge a flat fee for processing your order. In other words, it doesn't matter if you're investing €1 or €1,000, the fee is going to be the same. If you're investing €10 every week in the stock market and your broker is charging a flat fee of €1 for every transaction, that represents a transaction fee of 10% on your investments, which is ludicrously high. So you're better off waiting until you've accumulated a decent sum of money and then invest it. Otherwise, you're just going to be making your broker very happy. One alternative to fractional share investing when on minimum wage will be to start a pension. No matter what your job is, your employer is legally obliged to allow you to invest in a pension. And not only that, they're also legally obliged to facilitate the entire process for you. So instead of using a brokerage platform to invest, you could say to your employer, hey, I want to invest 5% of my wage in a pension, and you will be able to control where that money gets invested. The best part is by doing it this way, you're also getting tax relief, so you're saving money on tax at the same time. And if I was to personally choose between fractional share investing using a broker and starting a pension, I'd choose the pension every day of the week. So that's everything you need to know about investing on minimum wage. But before you go any further on your investing journey, you'll need to know about the 10 biggest and most common investing mistakes that beginners make. And you can find out that information by checking out the video popping up on screen now. Thanks for watching, and I'll see you soon.